So one of the things that I think is really important for us to discuss and kind of walk through is this confusing idea of the difference between the base and the PUA. I know for me, when I first started really learning about IBC, that was kind of this confusing idea of I understand um, kind of what that is, but I don't really know what it means. And so I want to walk you through exactly how that works. Okay. And so when you think about the total contribution that you would be wanting to fund your policy with, let's say for round numbers, let's say it's $10,000 a year. Part of that $10,000 is going to be the base premium, and the other part is going to be what is known as the PUA rider premium. And when you add those two things together, that equals the total contribution. Okay. So when you think about the base, here's what I want you to think about. Think about the base as being the minimum required, right, contribution that's necessary in order to keep your policy open. Now, when I say minimum required, what I'm really getting at is that at least in the beginning part of the early years of the policy, while you're capitalizing it, right? Once it becomes capitalized, there is a tremendous amount of flexibility, right? With not being able to be required to have to fund that if you don't necessarily have the funds to do it, or whatever that looks like. But it is in the early parts of the policy. It is the minimum required necessary in order to keep the policy open. The next thing is that this is what is designed by and large for the long term. Okay. So when you think about whole life insurance, or when most people think about whole life insurance, they're thinking about their granddaddy's life insurance, right? It's this kind of old school type deal that there isn't really a lot going on early on, and there's maybe something going on the back end. That's usually because those policies are designed with all base. Now, that doesn't make that a bad thing, right? That just makes that what it is, right? The next thing is that this is what largely, determines the size of the death benefit that you're buying. So the bigger the base, the bigger the death benefit that you're buying, the bigger the amount of insurance policy that you're buying, which means by default, right, is that this is where most of the expenses come out of. And when I say expenses, that means paying for guarantees, that means paying for overhead, for operations, for compensation, like all of that is driven by and large by the base premium. The other thing, which most people I don't think realize, is that this is also the biggest driver, right, of your dividends. So the bigger the base, the bigger your dividends are long-term in the contract. Well, so when we think about then the next piece of this, that's the PUA, right? And what the PUA stands for is paid up additions, okay, is what that means. So it's the paid up additions rider. Now, mind you, this is a little known rider that most people that are licensed to be able to sell insurance, right, don't even know exists. Okay, I know when I first started in the industry, the company that I was with in the beginning, they didn't teach me about this. And this could legitimately be the difference between hundreds of thousands, if not millions of dollars in your policy in the future. So when you think about the PUA, this is an optional, or extra contribution that you're choosing to put in above and beyond the base. So let's go back over here to this $10,000 contribution number. And let's just say for all intents and purposes that your base premium was, let's just say it's $4,000. Okay. It could be 2,000, 3,000, 5,000, doesn't matter. Let's just say it's $4,000. And then let's say that the PUA was $6,000. So based on what I just explained, what is the only minimum required contribution every year? Yeah, just the base, right? That 6,000 is optional. If I have the cash flow for it, I put it in. And if I don't, I'm not required to. So it provides so much flexibility. Additionally, and this is so crucial, is that we use the PUA by and large for the short term. Okay, so an analogy I like to use all the time is that imagine this is kind of like rocket fuel, right? And so a rocket uses some 90% of its fuel just to get out of the Earth's atmosphere. And then it becomes the most efficient on the remainder of the 10% of fuel that's left. So we're using the PUA to make these policies hyper efficient as quickly as possible. And so what that means for you is that it immediately increases your cash value day one so that you have the liquidity that you need to go make your passive income acquisitions or pay off your debt or do whatever it is that you're needing for with those particular dollars. The other thing that it does, which is I think oftentimes underscored, is that it also increases your death benefit. And I'm going to get to that here in a minute. The next thing is that this is where there are minimal expenses, right, that come out of the PUA. There are some, but it's very, very small. And the other thing is that it also helps to drive some of that dividend component as well. Okay. Now, why is this death benefit component really important? Well, the reason is because actuarially, and I've said that before, right? But actuarially, I'm a super nerd, okay? These policies are designed so that at age 121, insurance companies are smart. They know nobody's going to live that long, right? Is that at age 121, the death benefit is designed to equal the cash values. So what does that mean? Well, if I graph this out, say cash value start here, death benefit starts up here. As my cash value is increasing, it's increasing in an effort to catch the death benefit so that at age 121 they converge and they're equal. Well, if I'm adding this rocket fuel to my policy and it's increasing my death benefit and it kind of changes the trajectory that it's going on, what is that going to do to my cash values? Well, it's going to force them to change that trajectory too, because now it has to catch up. Right? So that's a really, really good thing. Now, stick around for 2 of the next video, and I'm going to break down the numbers on how this really plays out. Stay tuned.